This is a debrief of the question Renshu, which tests accounting and ethics. In the introduction to the question, we are told about the year end and a little bit about the business. Year end is December 08. First requirement concerns ethics, ethical and professional dilemmas, and actions to be taken. So really two requirements. What are the ethical problems and what actions are to be taken? How do we get the extra 2 marks down here? By making sure that we link the scenario back to some knowledge of ethics. If you need to, pause the recording now while you read the scenario. Now, you don't need any accounting knowledge for this first part of the question at all, do you? But you understand the problem, and that is that they are exploiting people who are financially vulnerable, and the accountant is fully aware of that. So what we need to do is in each sentence, make sure that we bring together something from the scenario, some point of ethical knowledge, and some sort of explanation. Now, I've used a table. I would not use a table in the exam. I've just used a table to show you how my brain would be thinking about this. First point, remember always, you can see I'm linking the scenario with knowledge, is if the accountant is an ACCA member, then she or he is bound by the ACCA Code of Ethics. You could always say that for 1 mark. We're told in the scenario that the accountant gets commission. So there was a reference up here, wasn't there, to commission on the loans. Extraordinary interest rate, isn't it? 1,076% an annum, where most people pay about 5% or 10%. Anyway, there we go. So she or he gets commission. Think about ethical principles, think about ethical threats. Don't list them all, but clearly that would cause potentially a problem with the person's objectivity. You can't just say objectivity, you need to explain it. So for each of the principles and each of the threats, make sure you're able to finish the sentence. Objectivity means, for example, she or he must avoid bias. Now, we also know that there are threats to objectivity, aren't there? Like self-interest, familiarity, things you met in AA. The one that's relevant here is self-interest, because she or he might become unduly dependent on the commission, in the same way as an auditor might be unduly dependent on the audit fee. There's a point I can make. She or he is aware of the bias in the system, so they know that something's going on. That was back here in the scenario. There it is. The financial accountant has full knowledge of the system, so I linked that to integrity. Again, it's not enough to say this is a breach of integrity. Say what it means. Integrity means that you must be straightforward in business. And I wanted to get professional behaviour in, because clearly the interest rate is ridiculous. So I did. So what do we say about professional behaviour? Damage reputation of the profession. So for each of the threats and each of the principles, and please don't muddle them up. It's not that much to learn, is it? Make sure you can finish a sentence, and then everything would be fine. I've brought in objectivity, self-interest, integrity, professional behaviour, and explain each of them and links them to the scenario. My actions: The accountant will need to talk within the business. Do you remember this phrase? With senior management, especially non-executive directors, those charged with governance. That's my TCWG. Those charged with governance. She might need to seek advice from the ACCA. Might consider resignation. There's the first part of that scenario. Now let's look at the next part of the question. Requirement. Should a database and a domain name, two separate questions, be an intangible? Okay. And how should they work out the purchase price? Fine. So are these things intangibles? How do they work out the purchase price? In your mind, you should be saying an intangible is something that is separable or gives legal and contractual rights. So I'm thinking probably a database might give contractual rights. I'm thinking domain names can be separately sold, so they both sound like intangibles. Now I'll go and read the scenario. So if you need to, please pause the recording while you read the scenario. You can see the link words now, can't you? I can see the database is about contractual rights. I can also see that the domain names, wherever they are, well, they're for websites. So I would assume they're the sort of thing that you could sell on. So, and I can also see at the moment, they've allocated the price on a 50-50 basis. So two questions. The first one is, are they intangibles? Easy question. Here's my answer. Yes, they are. Intangibles are identifiable. The domain names are separable. The contractual right is the database. They're actually both intangibles. How do we split the price? Well, clearly it's not 50-50. What accounting standard is being tested? Very, very important, IFRS 13, fair value. So we know fair value accounting, initially, again, how these things would be first recorded. Definition of fair value. Remember, it's the price at which assets would be sold in a regular market between market participants. Here we are. Intangibles measure at fair value. Price that would be received in an orderly transaction, again from regular market participants. We can't work that out, but clearly a 50-50 split is a bit silly. So knowledge of IAS 38, definition of intangible, knowledge of IFRS 13, definition of fair value. Like all of this exam, what they're doing is testing your basic knowledge. Now let's move on to the next bit of the question and see what the requirement is. So, some kind of payment is being made. Okay, so we're crediting cash and debiting something. We're looking at this year. What happens if it's not if it is an intangible, and what happens if it's not? So your mind is saying, well, if it's an intangible, you capitalize it. If it's not an intangible, you expense it. Now, if you need to, pause the recording and read the scenario. Well, that's all a bit messy, isn't it? So in the past, they have been setting up an intangible. So they've been debited intangible, credit cash. That's fine. So that's what has been happening. Development costs, isn't it? Development. So, and the criteria were being met. Commercially viable, technically feasible. The company's got resources. No need to really write all of that out, is there? But we understand the basics there. Now in the current year, they've decided to expense it. Why? Are they saying that there was a mistake last year? Are they saying they've changed their mind? What's going on? Well, it says here they think they're changing. There's been a change in their strategic plan, whatever that's supposed to mean. Because of that, they may not get the money in. Okay. And therefore, they think it's a change in accounting estimate. We could end up in a real muddle here, couldn't we? So let's start off with the first bit. Assume that it was originally an intangible, and that was correct. So in the books, you've got an asset. It doesn't matter whether it's tangible or intangible, it's in the books. And they're now arguing that they cannot actually get the money in that they would need, so-called recoverable amount. That's a question about impairment, isn't it? So, if they cannot generate enough cash, whether you're talking about a building or development costs, it's the same. This is a question about impairment. So the first part is where we're going to have to explain that the asset will have to be impaired to its recoverable amount. Here we are. There's my first part. Don't just de-recognise it. You can't just take it out of the books completely. It will disappear, I suppose, if the recoverable amount is zero, but we're not saying that necessarily. Demonstrate your knowledge of impairment. Easy mark always is to say that the loss would be in the profit and loss, and that the asset must be written down to recoverable amount. And then, of course, you can explain a bit more about that, can't you? Greater of value in use, fair value, less cost to sell if you need to. That's fine. So, if the payment should have been capitalised, it's an impairment. If the payments should not have been capitalised, we made an error. That means that last year's accounts were wrong. So that means, doesn't it, it's now a question about prior period adjustments. What do you remember about those? You remember that you have to, again, adjust last year's accounts and make an adjustment against opening reserves in the statement of changes in equity. Now, when you did FR, you had to do the numbers, and they were a bit horrible. This is SBR, we don't have to do the numbers, but we still have to explain the rules. So here we are. Where are we? If the payments should not have been capitalised, well, last year they made a material error. I will need to adjust the comparatives and adjust the retained earnings brought forward in the statement of changes in equity. Don't forget, in terms of the basic knowledge, like development costs, prior period adjustments, intangibles, use the flashcards on our website to make sure your knowledge is tip-top. That's the end of the debrief of this question.